Are you sick of hearing about the Fed pivot yet? Now, what if I told you that the Fed pivot, as it's being described in the media right now, doesn't really matter? What's up, guys? I'm Nobody Special, and everybody is talking about, will the Fed hike by 50 basis points in December or 75? Is it a pivot? Isn't it a pivot? And I'm here today to tell you that it's the wrong thing to be looking at. While everybody in the press is talking about interest rate hikes, nobody is looking at the Federal Reserve's balance sheet, and that tells us that we are still a long way off from the end of this tightening cycle. Now, what you're looking at here is the Federal Reserve's balance sheet going all the way back to 2007. This is all of the assets, the treasuries and the mortgage-backed securities that the Federal Reserve has bought. And if you move me out of the way, you see here where this line is flat? That's a normal Federal Reserve balance sheet. And then the GFC hit and they started buying all those assets. We had QE1, QE2, QE3, QE, I lost count, on and on until they started tightening back in 2017. And I want to compare this tightening cycle to the last tightening cycle. And when you compare, you'll see that this thing is only just getting started and that we've got a long way to go before we're finished up this time around. Now, first of all, for you new folks, I just want to clarify what tightening is. Tightening is when the Federal Reserve reduces the size of its balance sheet. In other words, they destroy money. Now, all of these assets that you're looking at on this chart, these are debt instruments. It's either a mortgage-backed security or mortgage bonds, or it's a U.S. government treasury bond. Now, these debts are constantly being paid back. They're constantly maturing. And what the Fed usually does is when those debts get paid back, they take the proceeds of that investment and they just reinvest it back into the market. So there's no net change to the amount of buyers or sellers in the debt market. Now, when the Fed is engaged in quantitative tightening, what they do is they allow some of these assets to roll off the balance sheet. As it gets paid back, some of it doesn't get reinvested back into the market. Some of that money just goes up in smoke and disappears. Now, that might seem a little counterintuitive to some of you, but keep in mind the Fed just created this money out of thin air to begin with, so all they're doing is correcting that mistake. So this makes the Federal Reserve a net seller of U.S. government debt and of mortgage-backed securities. Now, what I want to do first is zoom in here on the last cycle of quantitative tightening from 2017 to 2019. Now, here is where we zoom in on that. Now, you can see this tightening cycle, it started in about October of 2017. It took a little while for that information to show up on the chart because this data is delayed, usually by 1 to 3 months. But you can see the chart starts to tick down a little bit, and then it steepens as they increase the pace of selling off those assets. Now, from October of 2017 through September of 2019, the Federal Reserve rolled off a total of $723 billion from its balance sheet. It took them almost 2 years to do that. Now, that event ended in what became known as repo madness on September 17th of 2019. That's when there was a sudden shortage of liquidity in the bond market, and there was a scramble for cash. Interest rates blew out overnight, and the Federal Reserve very quietly started printing money again and started increasing their balance sheet, and that continued all the way through the pandemic. So almost 2 years and $724 billion worth of tightening. And keep in mind, this started when the Fed balance sheet was only at about $4.4 trillion. Now let's contrast that with this. This is this latest tightening cycle that we're in right now. Now, this tightening cycle began in March of this year. Now, first things first, this tightening cycle began with the Fed's balance sheet at almost $9 trillion. Contrast that with the starting point of $4.4 trillion the last time around. So back in March, we started with the tightening cycle. We started announcing a target roll-off of $47.5 billion per month. You can see the chart starts to come down just a little bit. Then in September, we accelerated that rate to $95 billion a month. So right now, the target for unwinding is almost double the maximum rate of tightening from the last cycle. Now, that's a target. We're not actually hitting that target, something we'll talk about in a second. But what you're looking at here in this chart, this is really only 6 or 7 months worth of data, because keep in mind, these data points are delayed by 1 to 3 months. But what this chart is showing is since March of this year, we have unwound about $242 billion worth of assets from the Fed's balance sheet. And that's taken about 6 months. So we are 6 months and $242 billion deep into this tightening cycle. Now contrast that with the previous tightening cycle where we spent 2 years unwinding $723 billion. So if you use the previous tightening cycle as any kind of an indicator, then we're only about 1/3 of the way through this cycle as measured against the last one, both in the total dollar amount rolled off and in the duration of the tightening period. We're nowhere near the end of this cycle. And that metric looks even worse if you factor the starting point. We started at around $4.4 trillion in 2017. This time around, we're starting at more than double that. So if you go by a total percentage to be rolled off, we are still trillions of dollars away from actually completing this cycle. Now, another thing I want to point out is mortgage-backed securities. And I mentioned a few minutes ago that right now the target was $95 billion a month rolling off the balance sheet, but we're not actually getting anywhere near that target because $35 billion of that target is supposed to be mortgage-backed securities or mortgage bonds. When you take out a mortgage, they take all those loans, they package them up into a bond, and the banks sell them to investors, usually your pension or your 401k. Well, right now, the Federal Reserve owns $2.6 trillion worth of mortgage-backed securities. Now, you may notice up in the top of that chart, this number hasn't really come down very much. In fact, when you zoom in on that, look, this number hasn't really come down at all. Now, keep in mind, we were supposed to have been unwinding the Fed's balance sheet by $17.5 billion from March until September, and then starting in September, we doubled it to $35 billion. Now, as Danielle DiMartino Booth points out on Twitter all the time, this is a delayed snapshot. It takes 1 to 3 months for these transactions to actually appear in this chart, so this data is really only through the end of August, beginning of September, but still, we've barely budged when it comes to tightening of these MBSs. Since the start of this cycle, only about $61.7 billion out of a total of $2.7 trillion has actually rolled off the balance sheet. So forget the state of the housing market. Forget what the mortgage rates are doing right now. When it comes to the Fed's balance sheet, this tightening cycle has barely just begun. The Fed has only actually sold off about 2% of its mortgage-backed securities through this entire cycle. Folks, as far as the housing market is concerned, this tightening cycle has only just begun. And why is that? Well, a lot of it has to do with these higher mortgage rates. See, the Fed is having a really hard time rolling these mortgage-backed securities off their balance sheet. See, remember, to roll things off the balance sheet, the debt has to be repaid. Well, there are 3 ways that mortgages get repaid. The first way is the simple and slow way. You actually make your mortgage payment. When you make your mortgage payment, a little bit of principal gets paid off, and that mortgage-backed security gets a little bit smaller. The second way is by actually selling your house. When you sell your house, you pay off the mortgage with the proceeds. Well, look at this chart right here. This is pending home sales in the United States, down 31% year over year in this last month. People are being priced out of the housing market by these higher interest rates because they can't afford the payments on the houses, and so nobody is buying at these prices. And because nobody can afford anything that's for sale in the market, nobody is listing their own house, so the number of houses for sale is also in decline. Now, so far, home prices haven't really fallen very much because the number of sellers is decreasing at about the same rate as the number of buyers are decreasing. It may not always be that way, but regardless, right now, the housing market is frozen in place. Another way mortgage debt gets paid back is through refinancing. Well, what you're looking at here is the Mortgage Bankers Association Refinance Index, and you can see that is pretty low right now. Nobody is refinancing their mortgage right now because the new loan you take out is going to be at a higher interest rate than the one you're paying off. And just how bad is that? Well, when you zoom out on a max chart, you can see right now refis are at the lowest level they've been since the year 2000, more than 20-year low in mortgage refis. So long story short, folks, while everyone is out there arguing about the interest rate hikes and what are they going to do in December, will it be 50 points or will it be 75? Nobody is looking at the elephant in the room, the Fed balance sheet. And according to the balance sheet, we're not even in the second half of this tightening cycle. If you go by the total on the Fed's balance sheet, we've only rolled off about 1/3 of what we rolled off last time. We've only spent about 1/4 as much time doing it as we did last time. And if you go by a percentage of the total Fed balance sheet, it's something like 1/10 of what we did last time. And if you go by the mortgage-backed securities and how little we've actually been able to roll off, well, we haven't even gotten started in that department. So for all of these reasons, folks, it doesn't matter what happens with interest rates. Now, to be clear, the interest rate decision tomorrow will have an impact on the markets. We could see a big spike in stock prices if Jerome Powell comes out and says that we're going to slow down our pace of interest rate hikes. But as Johnny Bravo points out all the time on his channel, markets don't bottom while the Fed is still tightening. And if you look at this chart right here, and if you go by history, the Fed is going to be tightening for a long, long time to come. Folks, we are nowhere near a bottom in this market. It doesn't matter if the Fed pivots on interest rates. We've got a long way to go when it comes to the balance sheet, and that means we're still in the early innings of this tightening cycle. Until next time, live small and dream big.